So today we're going to explore about the difference between permanent account and a temporary account. Permanent account, by its definition, these are accounts that carry their balances over from one accounting period to the next. Okay? So example of these accounts are cash, accounts receivable, inventory, accounts payable. And as you notice, these accounts are the accounts that you'll be able to find in a balance sheet. That's why another term for permanent accounts are the balance sheet accounts. Then we have temporary account. By definition, temporary accounts are the accounts that always resets every after accounting period ends. Okay? Example of this are income, expenses, and withdrawals. Again, as you notice, these example accounts are seen in our income statement. That's why temporary accounts are also known as income statement account. So in summary, permanent accounts, okay, these are accounts that have their balances continued to the next accounting period. Okay, and for temporary accounts, these are accounts that resets its balances every after accounting period. Okay, and to illustrate that difference, so we'll not just look into the definition, but we're going to see its application. So here is an example of a financial statement. Okay, don't fret. I know it looks like a lot. There's a lot of numbers, but they're just numbers. Okay, so here we have the balance sheet or the statement of financial position and the income statement, also known as the statement of comprehensive income. Okay, so as you can see here, let's just focus on the balance sheet items first. Okay, and we say earlier that permanent accounts are also known as balance sheet accounts. So what you will see here on the left side listed are the example of permanent accounts. We have here cash, short-term investments, accounts receivables, inventories. Okay, so by the definition earlier, what does that mean? Okay, when we say the balances continues, okay, or the balances of an account is carried to the next accounting period. So let's illustrate that here. So we have different balances from 2021, 2022, and 2023. Okay, so let's take a look at cash for simplicity. Okay, for 2021, we have a balance of around 300,000. Okay, 312,483. Okay, so what does that mean is at December 31, 2021, or at the end of 2021, we have a cash of 312,483. And that also translates to, on January 1, 2022, or the start of January 1, 2022, okay, we have a balance of what? Okay, we have a balance of 312,483 under cash and cash equivalents. So in 2022, we start off with 312,483 balance. And by the end of 2022, which is December 31st, 2022, assuming we're using calendar year, okay, we have a balance of 250,470. So looking at the balances, the ending balances in each of the year, okay, we can say the cash and cash equivalents of Shoe Banks Corporation decreased, okay, from 2021 to 2022. And again, we are going to roll over this balance, okay? So this is the balance, December 31st, 2022. We have 250,470, okay? And like what we did with 2021, okay, this balance of 250,470 will be the balance at the beginning of 2023. Okay, beginning of 2023, the balance is 250,470 for cash. But at the end of 2023, at December 31, 2023, the balance for cash and cash equivalents is now just 129,852. Okay, I hope you're able to follow. Okay, so the ending balance of the current year, okay, what we did, the ending balance of the current year is gonna be the starting balance, okay, the starting balance of the next year, okay. The ending balance of the current year is going to be the beginning balance of the next period. That's how permanent accounts work. Okay? They carry over their balances. Okay? That's why it's important to know or to separate the permanent accounts and then the temporary accounts. Okay? I hope it is clear. So let's go to the temporary accounts. Okay? Earlier in the definition, we say the temporary accounts, okay, unlike the permanent accounts, they do not carry their balances. Okay? They do not carry their balances to the next accounting period. What does that mean? Well, temporary accounts or the income statement accounts, okay, zeros out, okay, at the beginning of the next accounting period. Okay, zeros out. That means this balance for 2022, 4,976,553, okay, will not be carried over to 2023. Okay, at 2023, okay, the next accounting period, we're going to start with a revenue of what? A revenue of 0. Okay? From 0 to 4,825,335. Okay? Unlike with the balance sheet earlier, where the balances, we just rolled them over to the next accounting period. Here, for the temporary accounts, that's why we call it temporary. Okay? Because the balances is only just for the accounting period. Once you shift to the next accounting period, you're always going to start with 0. That's the difference between the permanent accounts and the temporary accounts. Until the next lessons,